This is Wednesday. Usually we do this show on Monday, but we had the holiday here for Canada Day. So today we are going to be talking about how you can get started in real estate. This is all about real estate foundations. So what real estate investing is all about, all the different aspects of real estate investing and how you can get your first deal done. That's exactly what I'll be sharing today on the Real Estate Show. So to get started, we have to answer the question, like, why real estate? Of all the different investments, you can invest in paintings, you can invest in precious metals, you can invest in, whatever it is. You can go into the stock market, or you can invest in real estate. Why would somebody want to put their money in real property versus a really expensive painting by somebody who just put a couple brushstrokes on a canvas? Well, a couple reasons. So number one, the very first reason why you would want to get into real estate is cash flow. And I'm going to be covering this a little bit later on, where I actually walk you through how to calculate the cash flow in a property. But cash flow, if there's no cash flow, the deal doesn't happen. Cash flow is the lifeblood of the real estate deal. And when we start talking about portfolios and passive income and being able to live off your portfolio, this is where cash flow comes into play. What is the cash produced by the real assets that you own? And this is how you can retire with your real estate portfolio. Then we have appreciation. So appreciation is appreciation. Appreciation is how can we increase the value of an asset. And in this case, it's real property. How can we increase the value of the property so now we can make a profit with it? So let's say we acquire an asset at $1 million and we can increase its value to $2 million. Well, we've just produced $1 million of profit, not even counting the cash flow that the property is paying every single month. I'll be going into appreciation and all the different levers we can pull to make that happen. And then we have the tax benefits. It's no secret that the government wants us to buy and invest in real estate. Real estate is the foundation of the economy, especially in Canada. So we talk about USA and Canada, especially in Canada. You look at the percentage of GDP real estate takes up. Basically, the entire Canadian economy rests on real estate. So it's in the government's best interest to incentivize the population to acquire more real estate and to invest and improve the real estate, because that's a huge driving force. So look anywhere in North America, the government wants to incentivize money to go in. Because you look at, building, whether it's a house or an apartment building, whatever it is, you employ land surveyors, you employ environmental assessors. Then you employ people in the tax office, in City Hall with all their approvals. Then you employ all the trades. So you got electricians, plumbers, framers. You got the guys digging the holes. You got the porta potties for the guys on site, right? You got the clothing, the hard hats, right? You have all the material. So who's producing all of the plywood? Who's producing all the lumber? Who's producing all the roofing materials? Who's producing all the nails, right? And then you've got all the health and safety people that I can employ, all the inspectors, right? The economy is fueled by real estate. So you have one real estate project that happens, like so many jobs stem out of that, right? And this is why real estate is so powerful as an economic engine. Then a couple things not outside. So cash flow, appreciation, tax benefits are the main three reasons, right? But then for me, it's the tangible factor, the tangibility of real estate. So unlike a stock, where it's just a number on a screen, real estate, you can actually go to a real property. You can touch it, you can visit it, you can see it, right? You can smell the real estate, right? You can do all types of things with the real asset. It's not like it's going away. It's not like it's an NFT where it's just living online. It's a real thing. It doesn't go away. And I'll be covering in a little bit the benefits of getting into the housing side of real estate, because there's all sorts of different types of real estate I'll be going through in a second. But housing is especially powerful because people always need a place to live. And so, actually just touching on that. So a couple years ago when we had all the lockdowns, when we actually launched our multifamily conference, when everything shut down, when we have lockdowns, when the lockdowns happened, people closed up their businesses, everybody moved online. But what was the one thing people couldn't give up? It's their place to live. We've seen it with office space right now. A lot of companies, like we're the opposite. We're actually getting more office space now, but most companies are losing office space. And that's why the office sector is taking a hit, right? But for housing, if you're providing a roof over somebody's head, during the lockdowns, businesses got crushed, government policy destroyed a lot of people, but housing was strong because people need their homes, and that's the last thing they want to give up. So they will shut down the business. They'll bring their workout equipment in-house, so the gym shut down, all that type of stuff, but they won't give up their place to live. People will fight tooth and nail to keep that, and that's why housing is so powerful, and that's why it's so resilient. And you look over the past number of recessions, we get into multifamily. Multifamily is so stable. All right, so we've got cash flow. Hey, give me money, give me a check every single month. Appreciation, how can I increase the value of this asset and make more money with it? And then the tax benefits. Nobody wants to pay more tax than they have to, and the government has structured the tax code to reward you for investing in real assets. And then it's tangible, you can touch it, and then housing, it's rock solid. So I kind of touched on office space a little bit, residential, multifamily. Let me explain the different types of real estate, because if you're brand new and you're looking to get into real estate investing, you have to know all the different options. Because back when I started investing in real estate, so I was a real estate agent. Well, first I was trying to become a professional hockey referee, and then I had to get a real job. Then I got my real estate license, started selling houses, and I got my broker license, and I did that. And then at some point I realized, and I'm glad I did, I realized it a little bit too late. But I realized that I had all this money coming in and the money was going out just as fast. I had a nice car. I had a house that I was living in all by myself at the time. I was really stupid with expenses. I was really dumb. So I knew that I needed to start putting my money into something that where it wasn't just going to disappear the next month. Like I had to start building a portfolio. So I read Rich Dad, Poor Dad, got introduced to the world of real estate investing, and I haven't looked back since. But when I first started out, I was selling homes every day. Like that was my full-time job as a real estate agent. So naturally, I just gravitated towards, acquiring single-family homes. So I had a partner at the time, and we started acquiring some real property, some residential property. So I'm going to draw a line here down the middle because we've got two sides of types of real estate. On one side, we have residential, and then we have commercial on this slide. Let me go through residential because this is what most people understand, because most people know houses and all that type of stuff. So we've got single family homes. So that's the short form is SFH. You'll see that all the time, single family homes. So this is where you buy a house, and this is one of the deals I did, right, when I first started, right? You buy a house, and then the plan is to rent it out. That's what you're going to do. And then you can get into small plex properties. Now, looking back, this is what I should have done when I first started out if I was going to stay in the residential space. Because here's the problem. With a single family home, you have one family, one tenant living there. What happens if they move out? Your revenue goes from 100% down to 0% overnight. Your revenue is gone. What doesn't disappear is your mortgage payment, all the utilities, all the expenses you have, the upkeep, the maintenance, that stays. Now, I don't know what type of business, whether it's in the bug extermination business, all the way to like menswear and ladies wear to carpet cleaning. I don't know any business that can survive going from full revenue at 100% to 0% overnight. The business is toast, right? And this is where a lot of investors get into trouble, where they rely on a single tenant to pay all of their bills, all of their expenses for the property. So the next best thing, which is what I should have done, is to get into a small plex property. What I should have done back in the day, instead of buying a home for myself to live in, I should have bought a triplex, right? It's called house hacking now. Before there wasn't the term for it, but it's called house hacking. So you buy a triplex. So you have 3 units. So you can live in one, and then you can rent out the other 2, which means you have 2 other tenants helping you pay your bill. Your cost of living significantly decreases, and in some circumstances, you're living for free. And then what happens is once you decide to buy another property, you can repeat the same cycle. You bring in that third tenant, and then now you're positive in cash flow. Because if we look at the single family homes, it's really, really, really tough to make these things cash flow. especially if you're in a major metro. And then you end up in a position where it's called negative gearing. And that basically means you have to put your own money into the deal every single month because you don't have enough cash flow. You're not producing enough revenue. And like I said, businesses die without revenue. So you have to produce that. So, small plexes, duplexes, triplexes, that type of thing. That's the other thing you can do in the residential space. And then you have vacation properties. So we've all seen Airbnb, we've seen Verbo, that type of thing. These are generally short-term rentals, right? So you buy a cottage in a nice spot, you can rent out your cottage. People have been doing this for decades, right? So you buy the vacation property, maybe it's close to Disney. I'm taking my son to Orlando next month. He loves it there with the Jurassic Park ride, right? So vacation property, close to those spots, families will rent it, for a week or two at a time. Perfect. Right? You're more in the hospitality business rather than the real estate investing business. Because here's the thing. Think of yourself like a hotel, right? You have constant turnover of tenants, right? You have your guests moving into the hotel. You need a heavier presence in your operations because you've got that constant turnover. Now, the benefit is you can react to market shifts faster because you're paying per night. Right? Rather than a long-term year or 2-year lease in a single-family home where you're locked in there. With hotels, you're a lot more nimble in terms of what you can do in terms of cost. So you can have surge pricing on the most popular weekends. So, July 4th weekend, everybody goes away while you have surge pricing. With an annual 12-month lease, it doesn't really work that way. Now, there are downsides to doing the vacation properties, and it really comes in the form of legislation, bylaws. Because communities are trying to get rid of short-term rentals. So let's say you're in community A, you have a property that you're doing short-term rentals, and they pass a bylaw saying, well, you can't do short-term rentals anymore. Or you have to acquire a license, but they're only giving out 50 licenses, for example. Now the government has impacted your business in a serious way because now they've introduced legislation that's basically prohibiting your current usage of the property. So what do you have to do? You have to revert to those long-term leases like a Plex property or a single family home. So buyer beware, you got to be very careful because I know a lot of people where they've been in a position like that, policy changes like that, you get different people on city council and all of a sudden all your Airbnb portfolio isn't there. So proceed with caution. But that's typically for residential property. Now, on the other side, which is the world I knew nothing about when I first started. So I was selling real estate. I knew about houses. I was selling it on a daily basis. I started acquiring residential property. I knew nothing about commercial, but I wish I did at the time. If I could go back in a time machine, I would start with commercial. Now with commercial, we've got a couple different things. We've got multifamily, and this is apartment buildings. Right, so everybody's seen these big apartment buildings, a high rise, we've got mid rise, we've got garden style buildings. Everybody's seen these around. Multifamily is one aspect of that. Then we have retail. You got strip malls, you've got shopping malls, anywhere somebody's buying a product. Usually you have some nice store frontage in a downtown area. That's retail, that's commercial. Then we've got office. So like I said, office is taking a beating lately. The pandemic killed a lot of businesses, and it also killed how we use offices. For my company right now, we're actually expanding our office footprint. We're bringing more people in-house from virtual, but the general theme right now, the general consensus is that office is being less and less used, and a lot of buildings are in trouble because they're not leased up and values have plummeted. So, but I also have some friends getting into the office space right now to take advantage of that. So there's office. Then we have industrial. So warehouses. We call it the Amazonification of industrial. The need for warehouses has never been more than right now. I've got some friends in the warehouse niche, and they are making a killing with the properties they've acquired over the past 10 to 20 years. It's insane, the need for warehouse space, because we have so much product being moved all over, and it's all driven by the internet. So those are generally the commercial asset types that you're going to look at. Now, here's a crazy stat. There is about $22.5 trillion worth of commercial real estate in the USA right now. This is a multi-trillion dollar industry, the commercial real estate sector. $22.5 trillion worth of commercial real estate in the US. So if I'm looking for some place to go, commercial is where it's at. Now, why do I wish I went back in time and started in commercial? A couple things. Number one, it's more scalable. We're not relying on single tenants, especially if we get into the multifamily sector and office, right? The financing works a lot different. With residential homes, small plexus vacation properties, the lender is going to look at you as a borrower to qualify based on your own income for the loan. The bank doesn't care how much rent you generate from your triplex. The bank doesn't care how much rent you generate from your single family home. They care about how much money you make from your full-time job, your real job, and they're going to use that to qualify for the loan. On the commercial side, very different. The bank's going to look at the property first and look at the business case for the property. So you're buying an apartment building. Well, how much money is being produced by the apartment building, right? They're going to look at the property first, then they look at you and who's managing the property because they don't want somebody who's going to mess it up. But they're going to look at the asset first. Huge advantage. Then you've got interest-only terms. Like that's a topic for another episode. But there are so many advantages to getting involved in the commercial real estate space. And like I said, I wish I learned about the commercial space first because I would have skipped the residential stuff in a second and just hopped right into commercial. So I've been talking about cash flow, right? I've been talking about cash flow appreciation and how we can leverage that. So let me explain how cash flow works in real estate. Because right now you're probably listening to me, hey, Seth, this all sounds good. We got different types of real estate, blah, 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 blah. But how do I actually make money? So let me explain how cash flow works. So we've got the tenant, and the tenant's going to pay us every single month to use the asset. So let me just use like a single family home example to keep things simple. So we have the tenant right here, and they're going to pay us $1,000 every single month for the use of our property. Great. This is our revenue. So in business speak, this is our revenue. This is the money we're producing as a business, right? Because we have to think about real estate investing as a business. Now, we have expenses to run the property, and the largest one is going to be the mortgage. So the mortgage, let's say the mortgage costs us $500 a month to pay the mortgage and all the debt service costs, right? And then we've got utilities, we've got upkeep. I'm going to use keep this as a really simple example. So now we let's just say we have operating expenses. Let's say it's another $200. So all in, our operating expense per month is $700. So our cash flow, right, just to keep things very, very simple, is we got $1,000, we subtract $500 and subtract $200. So now we're left with positive cash flow of $300 per month, right? Because we're charging the tenant $1,000. Now we subtract our mortgage, we subtract all the operating expenses, and what's left over is our cash flow, which is different from NOI. So you're going to hear a term called NOI. Let me just do a line here. So NOI stands for net operating income. And in the commercial space, we actually value our commercial assets based on the net operating income, the cash they produce, which is different from cash flow. Let me explain why. For NOI, what we do is we take our revenue and we subtract our operating expenses. So in this case, our revenue is $1,000 and we subtract our $200 operating expenses, but we don't touch the mortgage yet. So in this case, it's $1,000 minus our operating expenses of $200. So our NOI in this case is going to be $800 of NOI. That's pretty good, right? Now to get the cash flow, we go below the line. It's called going below the line. And now what we're going to do is we're going to subtract the mortgage here of $500, and that's going to give us our cash flow of $300 per month. You see what I did there? So I take my revenue, which is the rent we're charging, and then there's other forms of revenue. So you've got, laundry, parking fees, all that type of stuff. But your revenue, you subtract your operating expenses, all the expenses that you have to pay every month to keep your property going. That's going to give you your NOI, your net operating income. And then you go below the line, you draw a line, then you take out your debt service, which is your mortgage, and that's going to give you your cash flow. Pretty easy. So that's cash flow. Now let me explain appreciation. And this is how you really make your money. So the best way I explain the difference between cash flow and appreciation is, I'm a big fan of cookies. So I think of the cash flow as the cookie crumbs that are leading me to the giant cookie at the end of the day. Because the cash flow, we're getting those checks every single month that come in. And at the end, when we sell the asset, that's when we realize that a lot of the profit because we've improved the asset. So let's say I acquire a property right here. I'm going to acquire a property, let's call it for $1 million. Now I'm going to pull on two different levers to increase the value of this asset, right? The one lever I can pull on is called operations. Now, operations, I'm fixing how we advertise, the staff we have, the rent we're charging, amenities, like all that type of stuff. That's operations. Light bulbs, make everything energy saving, everything efficient. That's operations. Then we have physical improvements. So physical improvements are your renos, inside, interior, exterior, signage, all this, like adding a gym, swimming pool, all that type of stuff. Those are the physical renovations, new parking lots, all that type of stuff. So we can pull on these two value levers, because if we improve operations, if we reduce our expenses by making the property more efficient, we make more money because our cash flow goes up, our NOI goes up. If we bring in better staff that can rent to more people and lose less tenants, great, our income goes up. On the physical side, if we do renovations on the property and we can improve or increase the amount somebody's willing to pay because the unit looks brand new, well, that's going to drive up our NOI. If we have better signage, so we get more inquiries, that's going to bring in more prospective tenants. We get the unit rented quicker. That's going to increase the NOI because we have less downtime. Adding more amenities, people want that. Perfect. That's going to increase the amount of rent we can charge. So everything goes back to that NOI equation, which is you've got your revenue minus your operating expenses, and that's going to equal your NOI, because the whole goal in real estate is increasing your NOI, especially on the commercial side, because the more we can increase the net operating income you produce, the more money somebody's willing to pay you for that asset because it's going to generate more money. That's the whole idea between real estate. So when we're talking about appreciation, we're forcing the appreciation of the asset. We're doing work to the asset, either on operations or through physical improvements, to increase the value of that asset. Now, the market actually appreciates itself. So if we buy in the right location and we get the right type of deal, the market's going to increase over time. It always does, because we've got the value of the dollar decreases because of inflation. The value of the asset increases. So what we do, this is the secret of real estate. So let's say we have debt. We have mortgage on a property of, let's say, $500,000, right? That is the cost of the debt. That is not going to increase. That's not like we're going to pay it down. Then we've got the cost of the asset right now. The value of the asset is $1 million. Now, let's say over the next 10 years, we're able to take this asset from $1 million to $2 million. Now, what is my cost of debt? Right here in this example right now, debt makes up $500,000, right? So I've got $1 million of asset value and debt is $500,000, right? So right now debt makes up half of the value of my asset. My leverage is 50%. But if I do things to the property, the market increases, I do the physical renovations, operational efficiencies, now that my property is worth $2 million and my debt's only a quarter of the value of the asset, right? That's going to free up more cash flow. This is a beautiful thing about appreciation. My debt stays the same, but the value of my asset is going to increase over time. So if I buy the asset right now, my debt's locked in. It's what it is. I'm going to pay it down over time, but the value of my asset is always going to be increasing over the long term. That's the beautiful thing about appreciation, and that's using leverage. Because right now with leverage, but mostly with stocks, you have to pay 100%. If you're buying a stock, you need to have the money. If the stock costs $100, you need $100. With real estate, because it's so stable, banks love lending on real estate. So I can go out right now and find a piece of property. And if it's a residential property right now, I can put 5% of the value of the asset down. And that's all I need. And the bank, as long as I qualify and I have strong, if I have the strong income or I have a guarantor come in with me, I can qualify for a mortgage with 5% down. Now, with commercial assets, you're probably want to go have 30% down or 40% down, but that's still better than getting into stocks. So what this means is I can go out with $1 million asset. I'm going to buy $1 million apartment building right now. And I have, $100,000 to play with. Perfect, right? I can use that for the deposit. Now I can go out and raise the money. So I need to, if I'm getting a mortgage, a bank's going to give me a $700,000 mortgage, right? Now I just need to come up with $300K. How can I do that? Well, I'm already bringing $100K to the deal. I just have to find another $200,000. Now I can go out into the marketplace because there's investors everywhere, right? We're talking about a $22.5 trillion industry in commercial real estate. There's investors who want to get in, right? People all over the world want to acquire real estate here in North America. I can go out and find two investors at $100,000 each. They want to invest in the deal. It's a good deal. They're going to make money because we're forcing the appreciation like I talked about. We've got cash flow every single month. They're going to get a check. And now they want to invest in my deal because it's a great business opportunity. I'm going to run the deal. They don't have to do anything. They're just going to bring the money. Now I have leveraged this piece of real estate. I'm in for $100,000. So I have wrapped up this piece of real estate and I control it for $100,000. The bank's giving me $700,000 and I've raised the other $200,000. This is the power of real estate. You can't do this with stocks. Like you can't do this with other assets. This is why real estate works so well, because the bank's going to give me 70% of the money I need. I can go out and raise the other $200K I need from other investors. And for $100,000, I control $1 million asset. Now, over time, generally speaking, every decade, prices will double. So eventually this asset, this $1 million asset is going to turn into a $2 million asset. And I'm still in for $100,000. That's the most powerful thing about real estate. That's how you turn leverage to your advantage, how you make it work to your advantage, and how you can build a real estate portfolio. So how do you get started? You're hearing me talk about, hey, like Seth, like this sounds pretty good. I'm just starting out. Well, there's a couple ways to get started. Number one, you can go search YouTube. Like I've got this YouTube channel right here, Seth Ferguson, youtube.com/Seth Ferguson. Check it out. We've got hundreds and hundreds of videos about YouTube. And you can start getting educated. So you can come to my conference, which is the multifamily conference, right? You can learn about all the different types of real estate, how people are doing it right now. You can read books. You can go to real estate meetups. There's so much content available that wasn't available when I first started because of the internet. Like the internet's made information more accessible. But if you're thinking, hey, listen, like I'm pretty serious about this. Like, I've been around, like I understand this, but I haven't just dipped my feet in yet. We're actually holding a workshop, a 2-day capital raising workshop. So we're going to be talking about real estate, but it's specifically how you can do this example of what I talked about, right? You get a bank to finance it, give you most of the money. Now you have to go out and raise the rest of the money from other investors who want in on your deal. This is what we're talking about at the 2-day capital raising workshop. So if you go to go.sethferguson.org/capital, there's a ticket for a 2-day workshop. It's myself and Brad Blazer. We're running this July 20th and 21st in Toronto. We're running it at Ryerson University. So at this workshop, there's no fluff, there's no fire, there's no smoke like we do at the big conference. It's 2 days of solid content. So we're talking about how you can find investors, where to find them, how to talk with investors. We're giving you the scripts. We're talking about how you actually position and pitch your deal, how you can talk with investors about it and make it seem like an opportunity that they want to invest in, right? And then we're going to talk about how you structure your deal, how you can structure the deal so your investors make money and you can make money, right? So you're not leaving money on the table, and how you can scale your portfolios using capital, outside capital, and all the different sources. So if that sounds interesting, go to go.sethferguson.org/capital, and you can get your ticket. We've got We've got general admission tickets for $897, and then VIP, small number of tickets available for VIP. You get special access to us, and then we've got some special VIP events. Generally well worth it to go VIP. Every event I go to, I buy the most expensive ticket because you meet the best people there. That's for $1297, coming up July 20th, 21st. So if that's interesting, go there. But if you're just starting out, you're like, hey, how do I get into this? Well, every single Monday, we're coming to you live with the real estate show. So make sure you're tuning in every single Monday for the real estate show if you want to learn more about this real estate type of stuff, and then check out my YouTube channel. So Rabbi, I think we're good. Like we're over time right now. So I hope this was helpful. We covered a lot. We covered why real estate. We covered all the different types of real estate, residential, commercial, all that type of stuff. We explained cash flow, appreciation, how to use leverage to get into real estate, and then how to get started. Right. So I hope this was helpful. Check out the capital raising workshop. It's coming up in a couple of weeks. It's going to be amazing. Like we've got a full workbook we're covering. I'm really excited because this is where I can really geek out and get into the nitty gritty of exactly how we attract investors, how we convert them, and how we can really raise and scale your capital raising. So until next Monday, I will see you then on the Real Estate Show.